point. I think that's a very important point, that not all the markets can get the same variation in the home sale prices. I mean, it all depends on the strength where the market is standing today. If the market is too high, then maybe there's a chance of larger delta. If market is right very at a very strong base, then the chance of the delta is very low.
Exactly. And yeah, exactly. And that's something that I do at my company, Realty Quant, actually, is providing market data for that, in the event. I'm not like pitching anything here, but in the event, like sort of like providing market data to sort of give an intuition for like different valuation in different markets and appreciation potential. Appreciation potential is another interesting thing. And that's also applicable to a passive investor, I would say, because if you think about how we pick markets right now, so we would look at, let's say, population growth, job growth, income growth, and all those different variables, fundamental variables, and we pick those variables, and then we say, okay, Charlotte, North Carolina is a great market because it's better in those variables than those other ones. But it's in itself, it's not a super data-driven approach like that, because you're kind of like taking like those few data points. And we don't look at it, let's say, across the US for like every single market or county and compare that well. And also the other thing is, so I did a study where I tried to forecast prices, appreciation, based on first forecasting those fundamentals, forecasting population growth, income growth, housing supply growth, and then off that to forecast the prices. And I found that I had like a 7% error. I had like that was like 5 times bigger than how they forecasted just prices themselves. And that's very interesting, I feel like, to a passive investor, because suppose that they're picking like a syndicator to invest in. They can go to, in different markets, let's say that they're working in different markets, and they can go to a market that, they can simply look at the price history of those markets. And chances are, and it kind of may sound like strange, but chances are they're going to do a better selection unless we're really early in the market cycle, like 2011, 2012, then they would need the fundamentals themselves. But if we're deeper into the market cycle, chances are they would have forecasted appreciation way better, to perhaps a 5 times better error rate if you do it in an actual technical way, by just pulling the prices, just like looking at, okay, how price performed well. If yes, then yeah, then it's like pretty high momentum, and just like looking at the price charts basically, which is quite interesting. So it's really looking at the price charts themselves by doing a study like this gave like 5 times smaller error than looking at the fundamentals and then predicting the prices of that. So it's quite interesting. So that's one thing that I feel is like very useful, applicable, and it depends on the market. Some markets have more momentum. So markets in Florida and Texas, they have very high, I would say Florida and Massachusetts even, by the way, interestingly, they have very high momentum, like, and momentum can be tested in different ways, like autocorrelation is one, like what's the correlation this year versus last year prices. And so the autocorrelation there in Florida and Massachusetts is like close to nearing 80%, which is very high. So in markets like that, simply picking like whichever cities have performed very well and looking at historical prices, even though historical prices are not predictors of the future, but if you have autocorrelation, they are. And so that's kind of like the more accurate approach. I was actually able to forecast like 2018 and 2019 price appreciation by state, let's say, just as an example, within 1.4% error by based on 45-year history. So it's quite interesting. So it's actually very accurate. But when I went the route of population and income and housing supply, I had a 7% error, which is big. I mean, 7% is a big. Yeah, exactly. So it's a very interesting perspective. So if they want to pick like the best appreciating markets, if they went, let's say, in Phoenix, Arizona, or those like very booming like Western markets like Phoenix and Austin and so forth, and had it been already the case that they appreciated, chances are that, in the past couple of years, chances are that trend is going to continue. Now, of course, that's dependent on, like, let's say if we were to have perhaps a recession or like other kind of triggers or a change in the market cycle, and then that could reverse. But under the same market cycle, like pretty strong momentum and like very much picking appreciation on that. That by the way holds even for overvalued markets. So even if they're overvalued, so the same appreciation predictors are the strongest ones. It's very interesting. It's just that simultaneously those markets then carry downside risk whenever the market cycle ends at some point in the future, let's say uncertain one.
Very nice explanation, Stefan.